should the market be incorporating more risk that the Fed doesn't get this under control, or do you think it's got the story right here?
I think the market generally has this story right. I mean, look, it's an economy that recovered very quickly. We unleashed a significant amount of pent-up demand very quickly before the productive capabilities of the global economy were back. And, you know, the old saying, you get that kind of money chasing too few goods and you get inflationary pressures. But what the market is trying to focus on is not a unique moment in time, but rather the longer-term structural story. And we'd have to ask ourselves, has the structural story for inflation changed? And when you think about globalization, you think about automation of the workforce, advanced technologies, aging populations globally, all of that would portend inflationary pressures moderating over time. And so that's precisely what the equity market is focusing on. You also add on to that the fact that household savings rates are down quite a bit. If you survey consumers, they say it's not a great time to buy durable goods. All of that points to a slowdown in activity, which should lead to a moderation in inflation.
All right, Brian, as you know, this is the Leisman Frost extravaganza. All, you know, anything goes this morning. So I'm going to ask you a question that I don't know if you've been thinking about this, but I've been thinking about this. All right, think this through with me. Let me know your mind on this one here. Inflation is up. Companies earn nominal, not real dollars, right? Margins have maintained where they've been over this period of time. That tells me company cash flow should be pretty high. Now, right now, the S&P dividend is negative, right, when you take out inflation. Is there scope, do you believe next year could be a year of rising dividends and or buybacks as companies have greater cash flow flow to their bottom lines from higher inflation?
Yeah, Steve, if you're going to quote the Grateful Dead, I guess I will too. Nothing left to do but smile, smile, smile. I think that's exactly right. I mean, companies are very well positioned. And you know, some of the concern that I heard from investors coming into this year was that valuations were too elevated because, of course, the stock market moves before the economy moves and the fundamentals of the companies improve. And so you've seen a year in which not only is the market up significantly, but valuations have actually come down because earnings have boomed. So companies are in very good shape. As you said, cash flow positive, and that does suggest a pickup in dividends and buybacks, all of which you would expect a couple of years into a business cycle, all of which should be conducive for equities. Now, we're not going to see returns, unlikely to see returns like we've seen in the last 2 years. I mean, you're up 18% and 27%. Returns are likely to be more modest, but nonetheless, it should be a good year for the equity market.
Yeah, and I just want to back up that conversation with, I was speaking to a friend of mine who was freaking out a little bit. He's an investor. He's like, wait, the dividend yield is negative, the real dividend yield, that is, take out inflation. And I said, hold on a second, because I'm not sure where that dividend yield is going to end up this year. And I have not heard it yet from companies, but you could imagine that with rising inflation, you might get rising dividends, maybe even increased buybacks as cash flow from higher inflation goes to the bottom line, of course, attenuated, I think, by higher input costs as well as higher wage costs coming their way. But so far, I've been pretty amazed, Brian. Last word very quickly, that profit margins have held up well. Is that your expectation for the rest of this year?
Yeah, I mean, profit margins are going to likely come down a bit over time, you know, as wages go up, as demand slows some. But there's nothing about a peak in profit margins that portends end of a cycle or end of a good time for the equity market. So, you know, my view as we enter into 2022, it's an economy that's going to moderate from very lofty levels, which should bring inflationary pressures down, should allow policymakers to remain, you know, relatively accommodative even in the early stages of a rate tightening cycle, and all of that is a good backdrop to continue to favor stocks over bonds, credit over treasuries.